What's going on, guys? It's your boy Kyle from Kyle Curtin Real Estate, and today I wanted to do a video that was a little bit different that I've never really done before. So basically on my Instagram and social media pretty much every day, whether it's a story or a post, I talk about some sort of investing or budgeting or anything like that, because that's the stuff that I love to talk about with people and I love it. So basically, like, I talk a lot about it, but I've never actually really shown what I invest in, or what my situation is, or like what I like to do and the nitty-gritty of things, like what I like to invest in, like how I started, that kind of thing. And I wanted to share that story for you guys today. So it basically started in 2017. I pretty much was really bored one day. I was on my computer and something, I don't know what it was, but something told me to just look up what investing was, and I did it, and literally everything changed for the better, like to really crazy amounts. So basically it really blew my mind to see that you could make money like on the side, like passively, while you're working, and like you don't always have to work for the money that you have, like trade your time for money. And I just found that extremely interesting, and eventually it led into like how the rich get richer, and it's just really crazy that there's a whole nother world based on what we're traditionally told to do. And I needed to learn more about it. So there was one day that really changed everything. Soon after, I learned about passive income and like what the possibilities were of being able to make money, like, and not trade your time for it, and start to create streams of income in other ways. I started to try and think of ways to be able to save up money for that first investment. So basically the goal was to have like $1,000 that I would put into a Fidelity account. And I didn't even know that I wanted Fidelity at the time, but some sort of investment brokerage that I could start investing, and it was money that I was comfortable to lose, if I was to lose it, because I would make it back. And basically the way that I decided to save up that $1,000 was I had a spare wallet laying around, and I did something a little different that I had learned online. So basically $1,000 was the goal, and I needed to find out a sustainable way for me to get to that goal. And basically what I ended up doing was kind of reverse engineering that $1,000 to see how long it would take me to save up for that and not clear my bank account, from my check every week or whatever. So basically what I ended up doing was taking that wallet, putting a little sticky note inside of it, and throwing $5 a day into it. And then I would be able to check off every day, every day that I did it, and I would be able to see what the amount was. And then like I was literally, physically tracking how much money that I had, and how long it would take to get to that $1,000. And that's something that really changed my life, for the better. And it was something that was guaranteed, because the numbers don't really lie. I could literally see the bills in front of me and the numbers, and be able to calculate how many days that it would take of doing that to get to the point that I wanted to get to. While I was saving up that $1,000, that started to get me into my love for business books and personal finance books and that kind of thing. So I ended up basically, after just researching all kinds of investing stuff, and what certain things were and what are stocks, and what's the difference between the different asset classes and stuff. Basically I found this book that's extremely popular in like the investing community, and it was called Rich Dad Poor Dad by Robert Kiyosaki. And there was another one called The Richest Man in Babylon by George Clason. And I saw them on Amazon, and I remember going back and forth. I was like, because I wasn't really into books at all, or reading or anything. So I was like, you know what, let's do it. I think Rich Dad Poor Dad was about $8, and The Richest Man in Babylon was probably about the same. So for under $20, I got those two books. They came in, and I started Rich Dad Poor Dad, and that book entirely changed my life, like, to crazy amounts. And that's a book that I'm definitely going to be reading at least once every year, just to refresh for probably the rest of my career, honestly. I'll drop a link for that book down below. because that book literally changed my life so much. And it showed basically cut and dry why the rich get richer and how to build wealth like legitimately and not, through scams and, scamming people for their money and doing, you know, like guru classes and all that kind of thing. And I've read it way too many times already, and it's just the amount of information in that book for the price that it is absolutely just incredible. And I wish I could give a copy of that book to every single person out there, regardless of if you're into investing or not. It really changes the way that you think about your money, and it shows basically cut and dry what an asset and a liability is. And that book is so crazy. I'm definitely going to be reading that for the rest of my career, just over and over again. The Richest Man in Babylon, the other book, that was another one that really impacted, the development of my mindset for money and, what I like to do with mine and investing and, kind of how to set yourself up. The rules that have been in this book are, like really old. Like, this book's been around since like the 1920s or 1930s and republished pretty much over and over again. But the laws in this book, there's 10 of them, are, I'm sorry, the wind is going a little crazy. But the laws in this book have been around for a really long time, and, they're gonna be around for a very long time because they're as true then as they are now, and that's really crazy. That's definitely another book that I'll drop in the description, for anyone starting out, that really impacted me in a really good way and kind of started my career. After I read the 2 of those books and saved up that $1,000 that I wanted to put into my first brokerage account, I ended up on my 18th birthday, because that's kind of when everything was legal, for having an account and stuff like that. Basically, I hopped online on Fidelity, opened up a simple brokerage account, deposited my money, got all the paperwork aside, and I started looking into what I wanted to buy for my first stock, and it was definitely one of the really good starting points that I had for everything that I wanted to do. At this point, I'd been researching investing for a good year, watching a ton of videos, reading a ton of books that I bought, filling out notebooks worth of information and highlighting stuff and just learning a ton about investing. And, at this point, I wasn't really sure what I was going to invest in because, I was brand new to this and this was literally my first foot in the door. So I was pretty much going off of like what they said in the videos for more of a conservative approach, because I didn't really know anything about volatility or, risk or any of that yet. I just had kind of an idea. So I tried to go for more of a conservative approach, which is still kind of how I am now. I'd rather be more conservative with a slower growth than risky with a lot more to lose. But basically I ended up buying an exchange traded fund, which is basically a folder that has a bunch of stocks inside of it, or pieces of stocks inside of it. So you're not just buying into one thing, and if it goes down, then that's it. You're kind of buying into a folder, so some of them can go down and some of them will go up, and it will kind of equalize, and it should go up over time, hopefully. But the first stock that I picked was XLV, which is basically like a healthcare sector fund. So basically that was a folder of a bunch of healthcare stocks, because you kind of figure that it would be a pretty safe assumption that everybody is going to need healthcare, whether we're in a market downturn or the market's going crazy. Everybody's still going to need to see the doctor at the end of the day. So that was kind of the mindset that I had for establishing, buying that first fund. And I still have it to this day, and it's great. So a little bit of time went by, and I started reading some, a bunch more different books, because now I was kind of hooked into the business and investing book, kind of hobby, I guess. And basically one thing that I really wanted to do was make a dividend portfolio. So basically a lot of companies, that issue stock, basically reward their investors with a dividend, which is basically like a percentage of the stock price that they'll pay to their investors literally just for having the stock. So a lot of companies do it quarterly, meaning they'll give you stock dividends 4 times a year. Some companies do it biannually, or they do it like once a year. I've never really seen any of those. I've only really had companies that are quarterly, and a lot of companies do issue them. Some of them don't, though, because they'll want to reinvest that money back into growth, like company growth, so then the stock will appreciate more. But anyway, so that's something that I really wanted to get into, because with those dividends, given that they're very, very small, they're usually under $1 a quarter. Obviously, depending on what you pick, it's going to be different for every stock. But one thing that's really big with those is as long as you keep investing in those stocks and you start to gain a good amount of volume, like have a lot of stocks, then you'll start to have, your dividend will start to get a lot bigger. And then you have the option of either having that dividend mailed to you in a check or reinvesting it back into the stock. And the crazy part about that is, depending on what you pick, things can snowball. So if you own a stock that was $1, these are just, crazy numbers, but it's just to kind of prove a point. So if you owned a stock that was $1 and you had 10%, or you had a 10-cent dividend, so 4 times a year you would get 10 cents, so that's 40 cents. Now it would take 2 years and 2 quarters, 4, 8, 10. Yeah, so for 2 years and 2 quarters, that's how many dividends it would take to get the amount of a full stock price. So that would basically be 10 cent dividends. So then that would be $1. So now, if you decide to put it back into the stock, then it would buy another stock for you. So instead of having, however many stocks it would take, you would have another one, and then it would start to compound faster. And then, the more stocks you have, the more dividends you have. And then it just starts like a vicious cycle, and it starts to snowball. And, things can get really crazy fairly quickly. Well, not fairly quickly. Things will get crazy over time. And, it's all happening just from you tossing money into it. And, you're still working your day job or whatever you're doing, but now you're starting to get money from the dividends, reinvesting them back into the stock itself, and then the stock will appreciate, plus you're getting, the dividends reinvested to get more stocks. So basically the amount of bang for your buck starts to go crazy, the more money that you put into it. And it's really crazy, and that's something that I was really fascinated with. And I love my dividend portfolio now. I love it. I need to work more at it, but I have other priorities in mind. Along with my dividend portfolio, I was also looking into a Roth IRA, which is basically kind of a retirement account. So it's pretty much like a regular brokerage account, but the money is taxed now when you put it in at your current tax bracket, assuming that you're going to be in a higher tax bracket when you retire and when you can actually draw from this account. So basically the money is taxed at a lower rate now than if you were to take it out later, and you would, assuming that you'll be making a lot more money later on in life than now, then you'll get it taxed at a lower rate. So I had a really good time with that one. That one only has a limit of like $6,000, I think, depending on, how much income you make and stuff. Keep in mind, I'm not a tax advisor or anything, so, I can't legally give you tax advice. This is just kind of what I did as an investor. So I basically, filling that out completely and getting the $6,000 into that account annually was trying to be my main focus. But then I started to get into other, investments, and I still have my dividend portfolio and my Roth IRA that I put money in occasionally. But the next thing that I was getting into, which I wish I did before I did anything at all, was my emergency account. So basically with the emergency account, it's basically money that you're putting away that's liquid, like that you can draw from like very, very quickly and easily if you needed it in case of emergencies. So like if your car broke down or something and you needed to pay cash for repairs, or, a water heater went, or, you know, whatever, then you would have money set up for that, you know, in case you needed to draw from it. So yeah, basically, like, I wish I did that before I did anything. And a lot of people recommend like 3 to 6 months worth of expenses. I currently have 5, and you know, I like it a lot. I like to keep mine in a high yield savings account. It's basically like a regular savings account, but your money gains a lot more interest in it than it does at like a credit union or a regular bank. I go through ally.com, which is basically just an online bank. And I think that's kind of the reason why these high yield, you know, these banks can pay out these interest rates, because they don't have like in-store locations that you can go to. You know, they don't have to pay like tellers or building expenses or anything. So I think they kind of have that money left over to pay out to their investors, like to have that account. And basically, like, the interest rate fluctuates, but it's a lot better than like the, you know, 2 cents a quarter from your regular bank or whatever, or 2 cents a month rather. But yeah, I keep mine in there, so it's gaining interest, you know, and in case I ever need to draw from it, I can draw from it very quickly. And yeah, I really like that as, you know, my next investment. After I filled out my emergency savings account with like 5 months of expenses, I was started to get into real estate and started reading a lot more books. And you know, I ended up getting my license, and everything just really hit the fan. You know, I first got my license last year in July, I think. Yeah. So you know, that's when I started to really get into real estate investing. And you know, I found Biggerpockets. I've been listening to the podcast for a long time, and I've met a ton of people on there. You know, definitely met some real life people that I'm starting to maintain relationships with, you know, that are going to be very important, you know, very soon. And yeah, I'm basically saving up right now for a house, and you know, that's kind of my big thing. Everything else is kind of sort of on hold while I do that. So yeah, so that's kind of where I'm at. I'm trying to save up enough for a 3.5% down payment on a 2 to 4 family, hopefully around this area, you know, maybe Fitchburg, Lowell. I'm still kind of exploring my options at the moment, but yeah, I hope you guys enjoyed, you know, kind of the little bit of a journey that I've been on. And you know, I've definitely really enjoyed it, and I know there's definitely a lot more to come. And yeah, I really enjoy doing this kind of stuff and investing, and you know, investing in the bigger stuff. And it's such a fun thing, and like, it's so beneficial for you. And yeah, if you guys have any you know, questions or anything, or you know, any questions on, you know, how to start or anything, or how to open a high yield savings account or anything, you can feel free to hit me up on Instagram, you know, text me, call me, do whatever you want to do. And yeah, new video soon. Have a good day, guys.